Hi, welcome back to Susan's demo and training session. And today I'm going to explain to you the differences between periodic inventory system and perpetual inventory system, which is being found in the Autocount Cloud Accounting system. So there are two methods of inventory system, and it is up to you to choose which method you want to practice when you first set up the Autocount account book in the cloud system, right? So in the periodic inventory system, you notice that stock valuation is determined periodically, whilst in perpetual inventory system, the cost of goods sold is updated continuously, right? So that's the difference. So let me just go through the comparison. So when you do a purchase, all right, when you do a purchase transaction in the periodic inventory system, it will debit the purchase account and credit the creditor account, all right? Whereas in perpetual inventory system, it will be recorded in the stock account. So this stock will be found in the current asset, which is in the balance sheet, right? And it will credit the creditor account, right? So when you do a purchase return in periodic inventory system, it will be recorded as debit creditor and credit purchase return. And whereas in the perpetual inventory system, it will debit the creditor and it will credit the stock. Because this is a purchase return, so the stock value will be reduced. That's why it credit the stock account, right? So, and then when it comes to purchase discount, which some of you will be recorded as discount received in your financial report. So for the transaction, it will debit the creditor, it will credit the purchase discount or discount received. Some of you might be using this term. Then, whereas in perpetual inventory system, it will debit the creditor and it will credit the stock. Because this is a discount, the stock value will be reduced, right? So when it comes to sales, when there is a sales to customer, so in periodic inventory system, it will debit the debtor and credit the sales account, right? Whereas if you practice perpetual inventory system, it will also debit the debtor, credit the sales account. At the same time, it will debit the cost of goods sold and credit the stock account. All right. So because this is a goods taken out from the stock, so the stock value will be reduced. That's why it credit the stock account. Then when it comes to sales return, it will debit in periodic inventory, it will debit the sales return, or some of you might be using debit the return inverts and credit the debtor account. Whereas in perpetual inventory, it is the same. It still goes to debit the sales return and credit the debtor for the cost value. But at the same time, it will debit the stock and credit the cost of goods sold, right? So this involves these two accounts, stock and cost of goods sold in perpetual inventory, right? So when it comes to stock adjustment, it will perform a stock adjustment in Autocount. It will affect the value in stock balance report. The adjusted stock value will then be used as periodical stock value and enter in stock value maintenance at the end of period. So there is no double entry involved, right, in the periodic inventory system. Whereas in the perpetual inventory system, it will debit the stock, right, and credit increase in stock value adjustment. So when there is a stock adjustment increase in value, the stock need to be debited and the increase in value will be posted to the stock value adjustment account, which is found in other income, all right, in the financial report side. Then for the reduction in the stock value, it will debit the increase in stock value adjustment, or sometimes it will be found under the P&L as stock loss expense, or you stock write-off as a reduction in stock value, and it will credit the stock account in the balance sheet. All right. Next, we have the input of stock value, right? So in periodic inventory system, obtain stock value from stock balance report and key in the amount in stock value maintenance at the end of the period. So that is why when you use the Autocount system, the premise version, you find that at the end of the month, when you close your month's account, you need to key in the stock value under the stock maintenance, stock value maintenance, right? Whereas in perpetual inventory, no action is needed. The daily double entries have updated the value of stock and the cost of goods sold instantly, right? So that is the difference. Next, when to input stock value. So for periodic inventory system, it is when you want to um, generate your financial report, either monthly, quarterly, half yearly, annually, and also depending on the reporting requirement, right? So as and when you want to generate your P&L report, then you need to key in the closing stock figure, right? Whereas in perpetual inventory system, the stock value is determined, updated continuously wherever there is transaction involve stock movement. So for when you practice perpetual inventory system, you need not have to maintain any stock value, right? Now comes to cost of goods sold. Cost of goods sold is determined by how much on hand closing stock is left, right? How much on hand closing stock is left at the end of the period. The calculation will be displayed in profit and loss account using figures from stock value maintenance and related ledger accounts. So for example, when you print your profit and loss account, you will notice that you have a sales figure, then you have less cost of goods sold, whereby you have the opening stock brought forward from previous month, purchases for the month, less return inwards, less the closing stock. Now this is the closing stock. So you have to maintain that value, key in the value at the stock valuation maintenance, then only you can see your gross profit margin. Whereas in the perpetual inventory system, the cost of goods sold account is determined and updated continuously whenever there is transaction involve stock movement. It will appear in profit and loss as a ledger account. And then you notice that your financial report layout will be sales. You only can see the sales figure, less cost of goods sold, and then it will give you the gross profit, right? So this perpetual inventory system is normally practiced in larger companies, and for the normal trading companies, normally they prefer the periodic inventory system because the bosses wants to have a look at what is the opening stock brought forward from last month, what is the purchases for this month, and what are the returns, and what is the closing stock for this month, all right, in order to look at the gross profit margin, right? Whereas this, they don't show, all right? They just show you straight away the cost of goods sold because the stock is being taken up, is debited and credited between cost of goods sold and the stock account, right? Now, what are the chart of accounts involved? So in periodic inventory system, you notice that we normally have opening stock, closing stock, balance sheet stock, purchase account, and purchase return, right? Whereas when you set up the perpetual inventory system in the cloud system, you notice that your chart account does not show opening stock, closing stock, purchases, purchase return. You only have balance sheet stock, which is found in the current assets, as well as the cost of goods sold account in the profit and loss, right? So this is the big difference. Then lastly, we have these two methods which is suitable for which kind of organizations, like periodic inventory, normally in smaller business with small varieties of inventory, it is not easy to track cost value of each item movement. When not using good accounting software with strong stock valuation function, stock valuation is normally done on a physical stock take, alright, where valuation of stock is needed only occasionally or periodically. So the stock valuation is only done when as needed to generate the financial report. And normally the stock take, they will print out the physical stock worksheet in order to take the actual stock value. Then in perpetual inventory system, this is normally practiced in larger business or with multiple outlets. Business with large varieties of inventory, it is easier to track the cost value of each item movement. When using good accounting software with strong stock valuation, such as Autocount, alright, so it's easier to track the stock inventory. And stock valuation is rather difficult without using inventory software, so it is always good to have a accounting system with stock inventory, where stock valuation of stock is needed anytime and it's real time. So in perpetual inventory system, the stock figure reflected in the balance sheet, it is the actual real-time stock balance, right? So this is so much about the comparisons between these two inventory methods. So you can always think about it, which method you want to practice. If you are so used to periodic inventory system, as most of the Malaysian software is practicing on this method, then you select this method during your Autocount Cloud Accounting setup of the account book, right? So when you set up the account book, they will have an inventory method for you to choose. So that's so much about this comparison between these two inventory system. And do watch out for my next demo video on the perpetual inventory system. Thank you.